So without further ado, we're going to jump into the presentation for this evening. We have quite a lot to get through, and so I've asked the panel to keep the pace up. Now, the title of today's event is Investing in AI, Getting the Target and the Timing Right. And we'll have a chance for the panel members first to just go through and introduce themselves. Michael, do you want to just go first?
Sure. My name is Michael Axelgaard. I'm a partner at AI Seed Fund, which is a new tech fund set to invest in a portfolio of early-stage AI and machine learning companies. I'm trained as an engineer. I've got degrees in engineering from UC Berkeley and Cambridge University. I've also got a professional background in investment banking, where I structured deals and managed investments at ING Bank and Bank of America Merrill Lynch. And I'm really excited to be part of the panel tonight and just the AI and machine learning space in general. It's a really exciting time for us right now.
Thank you, Michael. Alex.
Thanks. My name is Alexandra Jarvis. I work at GP Bullhound, which is one of Europe's leading tech investment banks. We do more deals than anybody else in Europe, in fact. Prior to that, I was at Peel Hunt, where I was a technology equity analyst for many years, focused on public markets. I was ranked last year as the top stock picker in Europe. I do not have a PhD in computer science, so don't ask me anything too tricky on that side of things, but I do know how to make good investments in technology.
Thank you. Sia.
My name is Siavash Mahdavi. I actually have a PhD in artificial intelligence. Started my first company back in 2008, and then we exited that AI startup to a company called Autodesk. I'll tell you more about it in the slides. I've actually invested in 4 or 5 AI startups over the last couple of years, and I'm starting my own AI startup this year called A.I.Music.
Hi, my name is Richard Muirhead. Imagine my surprise when I discovered Charlie had the same surname. I have an engineering background where I was kind of educated in the necessity of solving real important problems in very elegant ways, something which Stephen Allett has impressed upon me over the years. I've sort of helped build 3 different companies, one indeed with Charlie called Orchestream, now owned by Oracle, one called Tideway, which is now owned by BMC, and a third one called Atomics, owned by CA. Possibly not necessarily 3 of the most exciting companies to be owned by, but some success over the years. And then I started something called Firestartr, which we'll talk about in a little bit, which is a seed investment platform. And I'm now general partner at OpenOcean, which is a venture capital firm.
Good evening. My name is Alex Housley. I'm founder and CEO at Seldon. We're a machine learning deployment platform. So we help data scientists take their models from a sandbox environment and put them into production. I've got a computer science background and I've been building startups since 2003. In the mobile data, last business was a recommendation engine where we learned that actually building out scalable infrastructure is a much bigger technical challenge than actually creating the algorithms themselves.
Thank you, Alex. So welcome, panel members, and thank you for being here this evening. So we're going to get cracking with the slides. And so just a very quick introduction for those of you who know about CognitionX. You'll have heard some of this before, but for those of you who don't, a little bit of background on us. We are a market intelligence platform. It's actually going to launch in a few weeks' time as a freemium service that tracks over 10,000 companies across the AI space and builds indicators as to which companies and products have traction in which markets, so by industry and by use case. So all of you are invited to be part of the beta program. It's actually, if you go to the website, you can register now and get access. It's a closed beta, and it will go open in 4 weeks or so. So that's a little bit about us. The other thing I'd mention is we're launching later this week our annual Innovation Exchange for AI and the AI Awards, which will be on the 19th to the 21st of June. And that's going to be something we not just repeat in the UK, but will be repeated in the US and Asia as well. So again, you're all very welcome to come and join us there, and there'll be more about that if anybody wants to talk to us afterwards. So very quickly on the AI landscape, we spend our time tracking all these companies, and we've got an incredible panel who are going to talk in detail about their experiences and that key topic, investing in AI. The one concept we want to explain on this slide is the difference between vertical and horizontal AI. So where we look at these horizontal lines here at the bottom, right at the base, we've got hosting and storage, databases, which is a very broad definition of that term, machine learning platforms, including Seldon, as well as some of the larger vendors who I should say aren't in competition, they're just different approaches to things, and you'll hear more about that later. And then along the top, the vertical plays are per industry or even use case in an industry. So obviously everybody's heard of Deliveroo and Ocado, which really are applying data science and AI to logistics. And you know, if you look at the other end of the chart here in agriculture, there's a lot of people applying the technology to drones and doing image recognition across farming land. Now, these slides are available afterwards, so we're not going to go through all the detail here, but do come and see somebody from the CognitionX team if you'd like to get a copy. There's obviously a huge amount of M&A interest, and Alexandra is going to talk about this in particular, so I won't go into too much detail, but we always like to have a little bit of fun, and the mafia are hard at work buying up all the companies that they think they can get their hands on. And you know, there's a good reason for that, because there's a huge talent shortage in the market, and there is, you know, as some people call it, an acqui-hire culture out there to go and grab up the very best talent before those companies get too big. The market is often talked about as if AI is in the future. This slide is just to remind us that the mentions or the debate about AI has reached an incredible crescendo. This is the Bloomberg transcript wire mentions of artificial intelligence. And you can see that's really just gone into exponential growth. And when you look at the real world of actually deploying AI, it's not all hype. 76% of companies surveyed actually have deployed one or more AI applications. In fact, when you dig under the surface, it's about 1.5 on average. And the anticipation is that there would be at least 20 plus different deployments within a large enterprise. So there is real progress. People are really starting to deploy this technology, but it is very much early days, and there's a huge amount still to come. So just in terms of key trends that we see going into 2017, one, definitely moving from a nice to have to a must have for organizations. There is this enormous shortage of skills, which is actually driving a lot of the entrepreneurship, because of course we can build software that makes it easier and for people to build solutions and makes them much more productive while they're building trained models and solving problems using this technology. And the last thing is, I think the great challenges in front of us in 2017 are addressing the trust issues around AI. Obviously, there's been a lot of concern in the public domain, and there's some very real parts of that, and there are also some Hollywood parts of it. So if we push aside the Hollywood fear-mongering, there are real questions around ethics, around data privacy, and accountability for when AIs make mistakes. And those are big topics and could take quite some time to work through. So that's a quick summary of the market from CognitionX's standpoint. I'm going to hand over to Alexandra to talk about GP Bullhound's perspective. And
thank you. Okay, I'm going to set the context and set the pace. I'm going to be very quick, hopefully, if we can get these through. So what I'm going to show you over the next few slides is the activity, the M&A and the investment activity already underway. And last year we reached a record as 160 deals, not last year but from 2012, and there was around 40 deals closed last year. Obviously the US taking a lot of that investment, but the United Kingdom not too far behind it. In terms of M&A, we're going through a huge growth curve here, as you can see. Obviously it takes 1 or 2 years to formulate your M&A strategy, so people have started this quite early now. It's really starting to peak. In terms of who's acquiring, it's all the big names, but Google, Twitter, Intel, Apple. There's a big rush for for AI companies and talent in particular. So people are paying up for talent. And this just shows the quantums that they're prepared to pay for that talent. These are AI companies, and the valuations paid around $5.7 million per employee. Which, if you want to send your children into a successful career, that's exactly where my son is going. I used to think he'd want to be a banker, but absolutely no way. This just chimes in terms of what Charlie was just saying. Record levels of investment, but this is really now starting to get into the mainstream. So we think that from 2017 onwards, we will see both businesses and consumers really beginning to adopt AI seriously. So that's me. Next person. Who's up next?
Fantastic. The pace.
Yep. Quick.
So next up is Richard.
Thanks. So quickly, before I kick into a few slides, which I promise you will be pretty brief, a quick story. Oh, I'm not mic'd up here? Okay. Okay, I'm speaking into the mic. So, as I mentioned, we built a company together back in the day. And as I reflected on that company and work subsequently, it kind of went through a few different kind of phases. So I think in our first company, it's arguable that we obsessed a little too much about the extremely exciting technology that had just hit the world. Because this was 95, it was 96, and there were IP networks and people were building the internet. And it was great to be incredibly knowledgeable at IP networks, and it probably gave us the opportunity to build a company. But technology is just one part of the equation. In my next company, I think if anything, I felt I focused too much on customers. And if you're too focused on customers, or just a couple of them, yeah, exactly. This can be you can be hoisted by that particular petard. So, and we were to some degree. In the third company, I was determined to look beyond that and focus on the market. But it turned out that it was a slightly more mature company. I reflected afterwards that actually I should have been focusing on the people in the company, and that would be the best area for me to focus. So all of this has informed how I think about companies and what makes truly great companies. And I try and apply it to the way in which we invest now at OpenOcean and indeed at Firestartr. So who's OpenOcean? OpenOcean is 5 partners who've scaled 6 different software companies over the last 20 or so years, one of which is MySQL, which actually remains today the world's most popular database. So about 60–70% of the world's websites actually still running on MySQL. And actually the team has also built MariaDB, which is a drop-in replacement for MySQL. It is arguably better. It's also not owned by Oracle, which is one of its sort of key selling points, at least for some people. It's still and very much open source. But so when you build databases in particular as pieces of technology, you have to be very, very focused on the applications you're going to use the databases for. Because if you build something that is just a raw tool and hope that people will work out how to use it and get value from it, that can be a big struggle. So there's a lot in common between their experience and mine. Anyway, we're writing checks at about 3 million in size at the Series A. I also, prior to that, founded Firestartr, which is a seed investment firm which writes checks more along the lines of 300K, and you can see some of the people involved here and the track record, but I'm not going to go into that. And we thought there was a gap, and I think there remains a gap for seed capital, especially from folks who can understand the struggle of company building and deep technology in Europe. In fact, I think there remains a gap for capital right across all of the stages. So we continue to build out our portfolio, and we've got about 50 companies in the Firestartr portfolio in comparison to about 20 actually in the OpenOcean portfolio, some of which indeed, like Big Data for Humans and others, are using different variants of machine learning and artificial intelligence. Going forward, we are going to double down on our focus on artificial intelligence and very, very data-intensive products and companies, and going to be announcing some more details about how we're going to collaborate with CognitionX to capitalize on the fabulous companies that we're meeting through the events with them. And that will continue to be in a very sort of tax-efficient form. And I've been giving a warning, so I better finish. That's great. Thank you very much.
Sia. So from investor to investor and entrepreneur.
Thank you very much. Okay, so I'm going to kind of zoom in more on kind of my own experience with having created and exited an AI startup. My name is Siavash Mahdavi, and in 2008 we created some technology that uses a range of kind of different AI techniques, from neural networks all the way through to genetic algorithms. And we used it to design 3D objects. And we were able to take things such as this. This is a simple part of an engine block with a couple of holes in the top and a hole in the side. And we asked the AI to redesign this to use less material, make it lighter in weight, but still retain the functionality of the component itself. And using our software, within about 5 minutes, it took it from here to this. The manufacturing technique we used was 3D printing. And I've been in 3D printing since about 2002. So I've experienced the entire hype cycle of that industry. And I'm seeing something similar here within AI as well. So it's interesting to see the parallels and be able to be part of the journey of two different kind of really emerging technologies. So at Within, which is a company that I started, we worked in aerospace, we worked in orthopedics, we even worked in footwear. These are some 3D printed soles that have been generatively designed using artificial intelligence, and that in fact customize themselves to the individual wearer of the shoes. This is for a brand called Under Armour. This is where the technology is today. So I managed to sell the company in 2014 to Autodesk. That's a San Francisco-based CAD company. They're famous for AutoCAD, which is the world's dominant kind of architectural software. And this is where it is today. So this is a screenshot actually from LinkedIn that I saw yesterday of our technology in use. So it's really great. This is a part of a wheel carrier for a race car. It connects the wheel to the suspension to the damping systems. And you can see this entire thing has been generated using artificial intelligence to be light in weight. The entire macro form and even the internal lattice structure has been optimized to develop this product. Now what's interesting for me is looking at AI and looking at Within, the company that I sold. The AI tech was neural networks, genetic algorithms, and something called support vector machines. We had to develop that, and it was at the core of what we did. But if you look at everything else we had to do to make it work, is this list down here. I'll just go through a few of them. Everything from finite element analysis to Boolean operations to functional representation. A lot of other tech that was really there to actually enable what we did work. So if you look at when we're talking about horizontal versus vertical kind of implementations of AI, we were very focused on a niche. We were focused on using AI for 3D design and really had to bulk up an ecosystem around it. So I exited that, now started a new company called A.I.Music, applying AI to music. And what we're really trying to do, without going too deep into what A.I.Music's about, is we're changing the way that music is consumed. From this purple circle here representing music, arrows pointing outwards, a one-directional static consumption of music where someone makes a song and you listen to the song, to what we call dynamic co-creation, where the song is a shape-changing song and using AI can adapt itself to better suit the listener. So that's a project I'm working on today. We've hired a team and we're starting to bulk out, and we're hoping to get an MVP out pretty soon. And we've done some investments as well. So this image in the background is of one of our investments in the Brooklyn Navy Yard in New York called New Lab, which is a really great incubator full of AI and robotic startups. We've invested in a 3D printing company called Grow, Nanotronics. We're investors in CognitionX, and we're very happy to see the progress that's been made here. And we have about 5 other investments that we're making our way through as well. Thank you.
Thanks, Ian. Alex, I think we should. Oh, sorry, Michael.
Sorry.
My mistake. My mistake. Michael's up next, then Alex.
No problem. Yeah, so I'm a partner at AI Seed Fund. We're a specialist technology fund investing in early stage AI and machine learning companies. Sure. We do that in partnership with Capital Enterprise, who run the London Co-Investment Fund, which is the UK's most active seed stage investor right now. They've also got the largest portfolio of early stage AI and machine learning companies in the country. We're a new fund. We just started fundraising in January, and we've already beaten our initial fundraising targets and look set to be oversubscribed when we close actually at the end of this week. So what we're seeing, as Alexandra also touched upon, is an acceleration in the number of acquisitions in this space, and the number of, in terms of their multiples, keeps going up. For seed stage investors, we're seeing anywhere from 5 to 30 times return on money after about 3 to 5 years. And we're seeing a very high prevalence of acqui-hire scenarios where corporates like Google or Microsoft are purchasing AI and machine learning tech startups left, right, and center, even when they don't necessarily need the technology, as a means of acquiring the talent in those companies and bringing them in-house. And in terms of the exit trends we're seeing right now in the market, about 40 to 50% of the time, after 3 years, we're seeing AI and machine learning companies fail. And that's actually a relatively low failure rate for an early stage tech investment, but a failure rate nonetheless. And so if you're interested in investing in AI and machine learning, like any early stage tech, you need to take a portfolio approach. About 30 to 40% of the time, we're seeing that acqui-hire scenario. And for seed stage investors, we're seeing about 2 to 3 times return on that. And about 10 to 20% of the time, we're seeing acquisitions at high multiples, which are averaging around 5 to 15 times for seed stage investors. At the AI Seed Fund, we believe we're at an advantage because of our deal flow relationships and our tech DD knowledge, which we believe will allow us to perform at the upper end of these distributions. And we're expecting 40% write-downs, 40% acqui-hires, and 20% high multiple exits after about 3 years. And that's going to be applied to our portfolio of around 15 to 20 AI machine learning investments. If you're investing in AI, you should, or any early stage tech for that matter, you should be aware of SEIS benefits. The AI Seed Fund is structured as an SEIS fund so that our investors can get all the very interesting SEIS benefits. The key 4 benefits that you can get for any SEIS investment, if it's structured correctly, are 1, capital gains relief. So whatever you invest in an SEIS investment, you can get 10% of whatever that is back in the form of a relief that can be applied to capital gains on the sales of other assets. You can also get an income tax relief. So whatever you invest, you get 50% of that back in the form of an income tax relief, which can be applied to future income tax that you have or back income tax. And then you can get a check back from HMRC to the tune of 50% of whatever you invest. So if you invested 100K in something like the AI Seed Fund, you can get 50K back on the income tax relief and 10K back on the capital gains relief upfront when we start investing in companies. The other 2 benefits are when the investments are realized. If they're structured correctly, then gains are tax-free. And if any of the assets on the portfolio are sold at a loss, you can also get what's called SEIS loss relief on top of the other reliefs. And if you add all those up, it's effectively a cap on the maximum you can lose on any investment in an SES fund's portfolio that caps maximum possible losses at 17.5%. So that's very attractive, and whenever you can, you should take advantage of SES benefits. Finally, the other thing you should know about investing in early stage AI and machine learning is that the very best deals don't come to market. They're funded directly out of universities and directly out of accelerators. Also, you need very specialist PhD level tech DD resources in order to be able to pick the winners from the losers. And the way that we solve that at the AI Seed Fund is through our partnership with Capital Enterprise, who are partners with the best computer science departments in AI machine learning in the UK. So that's Cambridge, Oxford, Imperial, UCL. They're also partners with the best deep tech accelerators in the country. So the likes of Entrepreneur First, Seed Camp, Techstars are all partners with Capital Enterprise. And that allows us to source those deals at an early stage before their valuations shoot up. A lot of times before they're spun out of universities, and a lot of times, sometimes before they even go into the accelerators. We also have, as a key member of our team, a guy called Thomas Stone. Thomas is a lecturer in machine learning at UCL, and he founded the company right here, Prediction.io, out of his PhD there. And after taking a relatively small early stage investment to get it off the ground and developing it for a few years, they turned that around and sold it to Salesforce.com last year for $25 million. Tom and our other PhDs have the ability to evaluate investments at a deep technical level to the point where they can go into the code and actually see whether or not the technology does what it says it does. Those are the key things you need to know about investing in AI machine learning. The time is right. You need to take a portfolio approach. You need to take advantage of SES benefits. You need a partner who can source the best deals for you and pick the winners with specialist tech DDD knowledge, and that again needs to be like at a PhD level. I also want to invite you to an event that we're having on Wednesday. The AI Seed Fund will be showcasing 3 of the hottest AI machine learning early stage startups in London right now at the event. And we'll also be closing the AI Seed Fund. If you're interested in investing, that'll be the last time because it looks like we'll be oversubscribed. If you're interested in registering, please go to aiseedfund.com. And if you'd like to contact me, my email address is michael@aiseedfund.com. Thanks for your time.
It's me this time, right?
Alex, you. Absolutely.
Okay.
Last but not least, so Alex is going to tell us about Seldon.
Okay, Seldon. We're a machine learning company. Machine learning is everywhere. It's recommending us products online, extracting spam from our inbox, and deciding which of our friends' status updates we should read. But it's really doing much more than that. It's really changing the world in some of the huge areas like agriculture, predicting crop yields, healthcare, drug discovery and image diagnostics, in manufacturing, self-driving cars, and last-mile logistics. The reason I'm telling you this is to start by explaining Seldon's purpose, which is to make the world a better place with machine intelligence, which is a slightly more humble way of saying we want to solve the world's biggest problems with machine intelligence. But if we can actually enable other people to go out and solve these problems, then we think that we can make a huge difference because the technology required to build machine learning is much more accessible and available. But actually putting that into production is a challenge. So the main problems that we're solving here are first the huge inefficiencies in that there's no open standardized platform to quickly build and deploy machine learning in the enterprise. Then there's a shortage of data scientists. There'll be a $30 billion excess demand in the US alone by 2018, which is fine for Google, Amazon, but what about the rest of the market? Well, for those, you can use machine learning APIs. But they come at a cost, and that cost is a loss of control. And that's really where Seldon comes in. We enable companies to quite simply leverage the core building blocks of machine learning. The video didn't start just then, never mind. Seldon is an open source technology platform. So the reason we chose to go open source is the best available technology is open source. So just ask DeepMind, who used Torch to build AlphaGo. They now use TensorFlow, which, by the way, we're a very big part of the TensorFlow community as co-organizers of the London TensorFlow, or TensorFlow London meetup. Second, open source gives companies full control and enables people to build communities where people give as well as take. So how do we generate revenue? Well, first, ironically, we actually provide SaaS services to our customers. Initially as a managed service, we have large enterprise customers working on very big integrations. We also charge for support and enterprise that solve key industry use cases like fraud detection and credit scoring in the finance industry. So a little bit about go-to-market, which is very topical given tonight's discussions. So we actually, if you look at these two axes and this quadrant, you have services and product, and then horizontal and vertical. So this was us, the mule in the bottom left. Basically, we've created an open source platform and put it out into a large global audience. But the only way we could really generate revenue in the short term is to provide services, managed services to those customers. Whereas I'm sure a lot of the investors would agree that this is the kind of holy grail of having a highly scalable product that's very focused on a specific vertical, and I would not argue with that. But there are different go-to-market strategies, and having already laid out the foundation of an open source platform, at Seldon where we're going is actually up here, which is to create a much more streamlined version of our open source platform with enterprise add-ons that actually enables us to create not just one unicorn, but our mission is to create hundreds of unicorns. If we can enable other companies to go out and solve these problems more effectively and make data scientists more efficient, then I think that is something the industry needs. My name is Alex Housley. Actually, I'll just quick slide on our Seldon 2.0, which we're releasing in the next quarter. Allows members of the data science team to work in a unified workflow. So, for example, the business owner can create business KPIs in a user interface, which the data scientists use to create models, which they can create using any of their preferred machine learning tools like TensorFlow. And then when they deploy that model as within a container, Docker container in a microservice, that then gets passed over to the data engineer, basically, who is the gatekeeper to putting that model into production. And that is actually one of the most sought-after roles in data science. If you think there's a shortage of data scientists, data engineers is a kind of multidisciplinary skill set. And at Seldon, basically what we're doing is productizing the role of a data engineer. That's me. My name's Alex Housley. We're Seldon, and we'll be talking a lot more tonight. Thank you.
Wow, that was an incredible panel, and we've not started yet. So I'm going to throw first question to Alexandra. Right. So I think what you said, more deals than anybody else in Europe. What would you say are characterizes some of the winning deals that have taken place? We talked about some of them just now, but they shot past as the slides flew by. And why do you think they won?
It's a pretty difficult question, but at its core, we're going through a stage where we're just putting together the building blocks at the moment. And so we're just seeing businesses. So if we look at Google, has a very, very broad set of requirements, but its acquisitions are actually quite targeted within each of the segments that it's really looking at. They're building up different layers of technology first, and then we're starting to move into the vertical piece at the moment. But this core idea of a lack of talent is really at the heart of a lot of it. So people are buying people, and not just any people, paying up for the best people, and then bringing the teams behind them.
And you said it was $5 million per person?
It's close to $6 million,
and
those are in the kind of the genuine AI space. Wow. At the moment, but there have been deals where they're almost priced at hundreds of millions of dollars in some spaces. The talent is.
Wow.
So.
And who's been the most active of the acquiring companies?
Google has done 11 deals because its requirements are so broad.
Right.
But across that whole space, and it's been happening since 2012. And as I said, it takes a couple of years to do these deals and to strategize around it and close deals. So people have been thinking about this for a very long time now. So although we're seeing the impact of it now in 2016, 2017, this has been a long thought through process. And
so stepping from a kind of macro view like that with Alexandra, Sia, you started a company You've been there and you've sold it, exited, and it's a true AI company, but it was a while ago. It was started a number of years ago. What do you think meant you had the success you had, and what was the appeal for Autodesk?
Well, so I started an AI company back in 2008, and in fact, I've been in AI, or a fan of AI, since '96 when I started the AI Society at school. So it's always been fascinating for me, and this is back in the days of like fuzzy logic. So this is before a lot of the new things were out. And I haven't really even experienced things like TensorFlow and these new types of libraries, because we had to write things from scratch. They didn't exist. We wrote things in MATLAB, then we went to C++, and we had to read books and write papers and come up with our own technologies. So Autodesk were interested in what we were doing because they could see that the limiting step in improving 3D design is people's imaginations and the engineering behind it. And they knew that software can do a better job. The advent of 3D printing, which if any of you haven't heard of, is a digital manufacturing technique that allows you to manufacture things that you couldn't previously make. So you have a lot more of what's called design freedom. And this newfound design freedom meant that the complexity of what you can design was exponentially higher than what was available previously, and it was beyond the grasp of a standard engineer. So they wanted AI to come in and really take hold of that and really be able to exploit those design freedoms.
And Autodesk is a big company. Why couldn't it go and hire some engineers and build that technology themselves?
Well, what we did wasn't easy. The AI itself fundamentally, it took years to develop, but if you look at the high-level math, it wasn't that difficult. It was the ecosystem around which we had to develop. So things like integrating it into simulation software, understanding manufacturing design rules, making sure that it can handle all the what you call polygons that define a 3D surface. So we had to really bulk out a lot of that. So if you look at our AI team at Within, there were 3 of us. And, I mean, the whole company was less than 10 people when we sold the company.
Wow.
And only 3 of us were.
And what was the sale price?
90 million.
Right. And who were your investors?
We had no investors. So we actually ended up growing organically. We had a TSB grant. So this is the Innovate UK. This is the name from back in the day. And we were just able to start with using our code, which kind of sat within MATLAB, doing consulting to generate the first revenues, and able to hire more and more people, and we were able to just grow organically.
Amazing. It's not often that you hear a story that way around. Would you have taken investment if it was offered, or did you not? You just didn't look for it? What was the story there?
We never got the deal that made sense for us. And then right towards the end, when 3D printing kind of went to this kind of the peak of the hype curve, and everyone was kind of jumping in, and I could see Autodesk wanting to come in, and Siemens coming in, and Dassault Systèmes coming in. We started to get people really interested in investing, and then they just missed their chance because we got the acquisition offer.
Got it. So Richard, Firestartr, OpenOcean got a big portfolio already. Is this a trend that's going to continue? AI companies, do they need angel, seed, venture capital investment? There's not many examples you see like that in Europe. If they do need it, why do they need it?
So the first thing I'd say is you should never listen to the advice of an investor when it comes to deciding what your company needs.
I should grab that mic so that the guys outside.
I should leave that definitely in the hands of the decision making, the purview of the entrepreneur themselves. But just bounding back a little bit to what's been going on, and from an investor's perspective, what we see, it is incredibly exciting for the European ecosystem that there been this uptick in acquisitions, but not just that, but that many of them are staying here in Europe. That the talent stays here. There's one speech company where the entrepreneur, he's based in Cambridge, and he's been acquired by Microsoft, by Google, and now by Apple. And in the first 2 cases, he was shipped off to the other side of the planet with the team, and they've learned now that that's not the way to go, and it's been left. The team has been left in Cambridge to continue working on the parts of Siri he's working on. and maybe there's some work needs to be done on parts of Siri. But so that is great that talent is staying here, and I think we see that in the kind of the funnel of entrepreneurial activity across both OpenOcean and Firestartr. So we see probably 200 or 300 different new companies each month, with some overlap between those two funds. And many of them now coming with experienced teams or serial entrepreneurs, which hopefully can, as going back to the importance of people, can make a huge difference to the success of these companies. And gradually, I think people are coming to the realization of how important it is to focus on the right problems. And one thing that was notable to me, actually, I was at the Entrepreneur First demo day 2 weeks ago or thereabouts, and then last week I was at the Y Combinator demo day. For those of you, probably most people have heard of Y Combinator, but the most successful accelerator in the world. And every single, I think, pretty much bar none, presentation in EF was talking about AI and machine learning, and that's good. But it was notable that there were a couple of standout exceptions, but most of the companies at Y Combinator were not talking about AI and machine learning. But that wasn't because it wasn't evident in what they were doing. It was a given that they were applying that technology to build great products and build great companies. And cut me off whenever you want to. But we're seeing great companies. We have seen them in the ad space, and you can argue whether or not there is such a thing as a great ad company. But certainly that's been used to great effect. Historically in cloud and security to deal with very large amounts of data to make those things work well, and increasingly so. And now currently looking at ones in fintech, looking at credit scoring, risk analysis, both on the consumer side and on the business side, which I think is a good thing, giving more people access to the capital they need and when they need it. And beyond that, perhaps the most important thing we're seeing is people working on back office functions like accounting and bookkeeping and lawyers, and how those might be made to freed up to focus on the high level functions and the more day-to-day things that automate it. But we're seeing all of those in the companies that come to see us on a kind of monthly basis.
Yeah, that's a very comprehensive answer, and I think the point about Y Combinator in the States, people are not talking about AI in those companies, but it's just assumed that every single one of those hot growth companies, of course they're using AI.
For sure. I
think it's really interesting. It's kind of, is it a category? Michael, you're obviously right in the thick of it. You're closing your fund in a matter of days. Where do you think the hot opportunities are? Is it in the picks and shovels, the horizontal technologies? Is it in the verticals within a specific industry?
Well,
what are you seeing?
It's everywhere. I mean, it's become an enabling technology, and anywhere where there's software or there are processes to be optimized, it can generate huge efficiency gains. And we're seeing really interesting AI and machine learning companies spring up in every sector, in every vertical. One trend that is interesting is the startups that tended to really get it right position themselves as solving a very niche problem, because the tech giants like Google and Microsoft are better at providing broad solutions, and startups can have an advantage if they focus on a very specific problem in a specific industry. So the ones that tend to get it right are ones that are doing something very niche and very narrow, but doing it very well.
Mm-hmm. No, that makes a lot of sense. I mean, actually, it's the perfect segue to Alex, your business, because Seldon is, as you just described on the slides, you're taking a horizontal view and you're building tools. And for some people, they'd say, God, there's 10, 15 huge cloud infrastructure giants out there. Surely they've got this nailed already.
Yeah, very good question and good point. So you can think of the horizontal players either being kind of like an end-to-end solution, which tries to basically do everything. And I actually think that the days of those solutions are very numbered. Like there's going to be lots of machine learning as a service companies that package up everything that I think will fail, including some of the bigger ones will not actually scale effectively in the enterprise.
Care to share any names?
Okay, quick straw poll. Who here is actually using an API or knows their company is using an API from Google, Watson, Amazon Web Services in their company? Okay, this is about 5% of the room. Maybe it's just really early days, but what we're seeing is that most organizations want to build their own models in-house. And that means they're using tools like TensorFlow and other sort of more lower level tools and more sort of hands-on tools that I know people like Sia and his organization would have been using to handcraft solutions because the competitive edge that you can gain by building something which is more bespoke to your organization makes it worth a while, and that's why companies are paying so much for talent. Within those those horizontal plays, there are very thin sort of slivers of horizontal functionality that companies are building. And so one of the things that I'm seeing when I speak to a lot of sort of decision makers at banks and big organizations is that they want to piece together the kind of best of breed of all the different components within their infrastructure, and they just expect them all to work together well. So basically there's this like unbundling of the data science stack. And so with that in mind, Seldon, we focus very much on the deployment layer of that. So it's actually nothing related to the cloud compute and the kind of core infrastructure. We utilize technologies like Kubernetes, which allow you to deploy Seldon's Docker containers across any of the cloud platforms. So we have kind of agnosticism built into what we're doing anyway, which actually makes us pretty competitive because large sort of cloud platforms, their open source strategy is very tightly aligned with their cloud strategy. So as an infrastructure play, having an open source tool infrastructure stack that deploys anywhere is kind of contradicts their sort of end game, basically.
So we could, and apologies if this is a huge simplification, you're almost like creating a productivity suite for enabling these models to be built more efficiently, fewer number of people.
Entered the twilight zone. No, yeah, exactly. So one big part of it is we make
maybe just get a little bit closer.
Okay,
to the mic,
sorry. Yeah,
I think they've got mine up too high and yours too low.
One big part of it is just making it much easier for data scientists to put their models into production, which you can do, using kind of like command line based technologies, which require a sort of greater, sort of more advanced skill set within your team, which then precludes sort of key members of your team from actually working, being a part of that process. But it also means you've got a tool chain, which can cause big problems when it comes to things like, you're going to press the button to put the new model into production, and have you got an orderly kind of audit trail that has every single model that was trained with a kind of a diff between each of them and the supporting documentation, and can you explain which for every single prediction that happened, what were the features within the models that actually caused that prediction to occur? When you then sort of enter a regulated industry, and you have to ensure that things like bias, anti-discrimination is taken care of properly because it's an important regulatory requirement. You can either build all that in-house. Google certainly at the moment, and other platforms don't provide that as a core part of their functionality. Our job is to really make that technology accessible to companies and allow them to deploy it anywhere.
I understood most of that.
Sorry,
but not all of it. Yeah. It was. I think it just serves to demonstrate how incredibly complex this domain is, and you covered a lot of very big points. It'd be great to be able to dig into them, but I know we've got a limited amount of time and to come back to the investment discussion. But it's fascinating to think that the big cloud platforms haven't got all the tooling that customers are going to need right now. And so I
would just add to that though, that they will through their marketplaces as well. So we are partners of Google Cloud. We are partners of Amazon and Azure. So there's obviously a large number of supporting kind of middleware technology providers that as a customer of any of these platforms, you will get access to, but they won't necessarily all be produced directly by those companies.
Got it.
Yeah.
Alexandra, you've been involved in the public stock picking side, and now GP Bullhound, you're obviously helping large companies pick the teams and the technologies they want to buy. As the market shakes out, what are the trends going forward? Where do you think, from a private standpoint, the opportunities are, and are they going to be public market companies to invest in that will give you exposure as an investor to AI? What are the options there?
So in terms of public markets at the moment, you've probably got really just Blue Prism as a sort of on the cognitive side. I mean, one way to play AI is in a very broad way, which is to assume that every software business that's written code over the last 20 years is going to have to rewrite or somehow amplify through AI over the next 5 years. So I often think that you've got AI companies out there looking for applications and applications looking for AI. There's all these businesses with very, very fantastic installed bases, excellent customer relationships, who can and who will have to transform their businesses using AI. So one way to play this is to kind of work out who are going to be the winners and losers of that. And it's very important those enterprises are able to access the kind of the technology that Seldon offers, because they're simply not going to be able to bring this technology in-house. And I see a lot of my clients in that space really struggling to understand how to pull in AI into their business, although they know they have to. So that's quite a big challenge.
And when you say they know they have to, you're talking about they need to go and acquire?
They need to acquire or somehow bring that technology in.
So, and you were talking about 140 companies, was it, last year?
And there was 40 companies last year, 160 over the last 5 or so years.
Okay, and are we expecting to see that go up, or have we hit a plateau? Where do you think we are in terms of the exits for M&A and AI-related companies?
That's always quite difficult to call. What tends to happen is that you'll have a larger quantum being spent, but maybe more consolidated into larger deals. Having said that, because we've got this talent issue, we are seeing universities really starting to crank the machine on turning out these data scientists now. So exactly where that plays out is difficult to tell at the moment.
And that would reduce the valuation that they would pay per employee?
Exactly. You've got to think that probably this trend may be coming towards an end, sort of on a 2 to 3 year basis. And then we go into this real productization question, the adoption question, rather than just the talent generation piece. Yeah.
So, and Sia, you've gone from being the entrepreneur, selling, then investing, a whole bunch of investments, and now you're throwing yourself back into an entrepreneur role. Mm-hmm. And I think, is it fair to describe A.I.Music as a vertical AI rather than the horizontal? And so you must be bullish on the domain. Tell us, what made you jump from being an investor and being across multiple deals into just throwing yourself into one again?
To be honest, it was actually hanging out with you.
Yeah.
No, I'm not even joking. No, because I was investing and I was really frustrated by seeing the entrepreneurs I was investing in not doing what I knew they was meant to be doing, and trying to guide them with these really long sticks. And I would see you just saying, well, we decided to do this, and so we just did it. And I thought, bloody hell, I just want to go back into doing it myself. So honestly, over the summer, I thought I'm going to jump back in. I saw the big trend in AI every single day in the news, AI startups. And I thought, well, I know how to do startups. I have a PhD in AI. I should really do a startup in AI. And so that's how I got back into it.
And why music?
Music because, for a few reasons. Firstly, I play the piano. I've always been fascinated by music. And for me, it's this really interesting space where it's what I believe one of the most creative art forms, and yet it really touches one of the most mathematical things we have. Music is pure maths as well. So you have this place where these two things are touching. And I've always been fascinated by what makes a good song, what makes kind of people resonate with music. And from an AI perspective, you see most of the things we're trying to tackle today center around kind of automation, robotics, things that are monotonous, things that maybe humans don't really want to do. So I was really fascinated by the challenge of trying to apply AI to one of the most creative forms and to see what AI can really do there.
Makes sense. It is obviously a lot of noise in the press about automation and the possibility of reduction in jobs. And I remember the whole discussion around the creativity is going to be something that AI is not going to get to. And of course, there's the AlphaGo example where AlphaGo came up with some moves that humans hadn't necessarily thought made sense in the past. Are we going to see musical composition above and beyond what humans have done?
I think what's interesting is kind of augmenting human creativity through AI. So you look at any kind of user interface, you look at digital software, what it's really doing is making all the mundane things simpler to do. So we've already gone from the big kind of production studios from the 80s and 90s down to basically a MacBook and a couple of speakers. You can pretty much compose whatever you like. I mean, we just want to take it several steps further. I think by applying AI to music, we may democratize and kind of be able to create generic music with a click of a button. And what that will do is actually, I'll probably hopefully push human creativity to these higher peaks and a different direction in musical style. But what I'd really like to see in a few years is AI create maybe what we wouldn't even describe as music, some sort of sounds, these sonic elements that can resonate with people, because if you really think about what music is, it happens to kind of sound nice, but it makes you feel something, right? If we can go straight, bypass the sounding nice and straight to feeling, you might find these really strange bings and bongs that kind of just make you kind of vibrate and make you really feel amazing, that are kind of connecting with you. So I think that's a direction we might want to explore as well.
Yeah. Sounds like raising children to me.
Bings and bongs. So Richard, you mentioned at Firestartr, you're obviously, you've invested in a bunch of companies. It's EIS, SCIS, venture platform, helping angels. So what's the plan around AI investing for Firestartr, and why would an angel work with Firestartr instead of just, they get a chance to meet Sia and they decide to back his new venture?
Well, they definitely should do that, of course. But as I said, I think the opportunity around AI is one of those that is becoming universal, I think it's becoming a little bit like the opportunity for software, full stop. That's the way we look at it, at least. Even venture capitalists or investors have to raise money, and we're talking to one LP, potential limited partner, and they said that they felt they were overexposed to software investments, and I think in the world where you think software is eating the world, that's a little bit like, to coin the phrase, getting tired of life, saying that you're kind of overexposed to software. So we see like opportunities right across the board, but the thing that defines the ones that are super interesting kind of are at that nexus between data wrangling in a very specific domain on one hand, and some sort of beautiful design on the other, and that's what makes the products themselves what we call delicious. And I think the reason why, as an angel, you might want to work with Firestartr, or as an institution invested at OpenOcean, is that first of all, it's great to be in a portfolio because this is inherently risky, and taking investment on board is not for every venture. And as I said, I wouldn't take advice from an investor necessarily whether or not you should do that. I think the incredible thing now about the way in which the means of production for these companies has been democratized is that you can start incrementally, very, very low cost, and make decisions as you go, as you build your company, as to whether or not you really want to swing for the fences, either at the seed stage or at venture. But inherently, if you're going to be one of those companies that swing for the fences, it's better as an investor that you're in a portfolio of them. So that's a good reason for doing that. We encounter those companies quite often. They can be outrageously profitable these days because not just the means of production, but also the distribution is so effective. And it's only some of them that make the decision that, to put it one way, at least they want to destroy that profitability, whilst they really try and build a very big and enduring company. And that judgment around the people and that business model is something that I think it's good to work with a team on.
one more question in relation to that. What have been the standout successes of your current portfolio? Were they expected?
No. I mean, all of them are expected, but none of them are expected. That there is, I think that's a truism of, and if any investor tells you, if you're really trying to build, global successes, that they could tell you exactly which one was to succeed. There's a famous blog post from Paul Graham, who built Y Combinator, about whether or not he understood, that Dropbox and Airbnb were going to be the many, multi-tens of billions of dollars companies that they are. And was it when he first met the entrepreneurs? Was it when they were in the accelerator? Was it at demo day? Was it when they secured their first finance? And it was none of those. And it was only later that they saw it, really taking off. So it is hard to do that. That's one of the reasons for the portfolio. But you can try to, as Michael said, bump up your average by doing things, in a sophisticated way, and kind of letting some pattern recognition, kick in, as well as the portfolio.
So it's both risk reduction as well as trying to make sure, you're actually in the deal that nobody really thought was going to be the deal, but turns out
I mentioned one in the OpenOcean
the
portfolio, which is it's probably only just kicking into serious machine learning now, but it's worth, it's say, at least half a unicorn, and if I'm kind of understating it. And the company's Truecaller, and so they have about 100 million monthly active users, about 70 million actually daily active users. So they're a very sticky application that essentially stores all your contacts in the cloud and blocks junk callers, and they're very popular on Android and in India and so forth. But the point is that they just had like 1 million users at the Series A when the investment was made. Then they grew nicely. Nobody really wanted to do the Series B because nobody was convinced. But then by the time they got to the Series C, they got Kleiner Perkins and Sequoia and Atomico on board with the bigger growth checks. So it's not only tough at the Series A, but it can still be tough at the Series B, and then it plays out as the company builds.
So Michael, you're going back to your fund position right now. You've set up a new fund. You must have done that for a reason. And there's obviously other venture capital funds in the market. There are seed funds in the market. What was the gap that you saw? Why build a new fund?
Well, we believe that in addition to having a portfolio and structuring things for angels so that they can take advantage of risk reduction through tax efficiencies like SEIS, that in this space in particular, you need to be able to have a special skill set in terms of picking the deals and understanding whether or not the tech is going to work. But then you also need to be a specialist in helping these companies grow. And through Capital Enterprise, we're able to offer incubation and mentoring resources to the companies once we invest. We can offer them a space to work alongside other AI machine learning companies in the ecosystem of other entrepreneurs and successful exited AI machine learning technicians. And we also are currently, through Capital Enterprise, offering Tech DD as a service to third parties who want to evaluate whether or not a given piece of technology works. And we've been recognized as being one of the best providers of this in the space, to the point where Google and Cisco use Capital Enterprise as a tech scout in trying to find interesting new AI and machine learning companies. And I say we specialize, but the great thing is, because this is an enabling technology, even though we're doing one specific thing, the companies that we invest in are diversified across sectors. So even though we're specialists in the sense that we know how to evaluate this technology, we know how to help it grow, the exposure that we give investors is to a broad range of sectors. And we're seeing AI and machine learning companies in healthcare, in fintech, in retail, in industries you'd never expect, but where a smart startup applying AI and machine learning technology to a specific problem can create huge advantages to solving a given problem in a given industry.
Luke, I'm going to hand you that. Do we have any questions from the audience for the panel members? I wanted to pass it over to you guys as we get towards the big question that we're going to end with across the panel, which is how do you pick the right target and how do you get the timing right? Alex, why don't we start with you and we'll go from right to left across the panel, and then we'll take questions from the audience.
How do you get the timing right? Good question. Okay, let me really think about that.
How do you pick the right target? Well, no, I think you're going first, aren't you? Sorry.
So there's two Alexes. So either one, but
Go, Alex.
Why don't Alex Housley starts? How do you pick the right target? How do you get the timing right?
So I would say starting first with the timing, that actually, the AI market is still extremely early, right? And although there's a huge amount of hype, there's only a very, very small amount of AI technology companies and large companies that are sort of building AI internally, actually moving into solving real world problems. You said only 1.5 problems per organization on average, with 20 as the kind of target. So it's really early. So but the winners will start to emerge quite soon. So even if it's going to take a long time to get there, now is the time to start investing in those companies, because in a few years' time, that opportunity will cost a lot more. So certainly now is the time to invest. And in terms of picking the right sector and team, I would say that there are huge opportunities across every major industry, but the areas which are probably more ripe for sort of longer term disruption are not things like advertising, e-commerce, media. It's things like energy, agriculture, manufacturing, and so I'd sort of look for companies which are starting to do interesting things very early on in that space, even if they're pre-revenue, pre-product, and as long as they've got smart people in the team and they're looking to tackle a big enough problem, then I'd say go for it. And a side point on that is also that the classic sort of metrics for success, I think, have been built up through many years of investors investing in bread and butter SaaS businesses, which are actually much simpler to sort of execute and then scale. Whereas to actually build a successful machine learning company, is considerably more challenging from a technology perspective. So even if someone hasn't got their MRR up to a certain level, but they've got some exciting technology and a great team, then that also say just go for it and help to give that team the resource they need to find the right timing.
Fantastic. Richard, you ready to?
Sure.
How do you pick the right target? How do you get the timing right?
So, you're looking for entrepreneurs who definitely have, and this has kind of become almost cliche, but have got that passion about what they're doing. But to the degree that they're probably slightly crazy, then you want folks who have, prepared themselves intensely. I mean, domain knowledge to understand what the application is. It can be a horizontal application, or it could be something more vertical, is extremely important. You need the PhDs as well these days. That's something you're looking for in the team. And you're looking for that level of perseverance that just doesn't even see the obstacles half the time. And then when we're looking at, that is the most important thing. After that, we're looking for something that just is self-evidently a delicious product, something that people don't just, use a little bit and download, that they love it so much they tell all their friends about it and all their colleagues, and they want to get them involved as well. That's how we think about it. And then after that, we're getting into trade secrets, but how to pick the timing? Well, you kind of want to be involved as early as possible in the ones for which those two are true. And then it's a question really of how great you can be of convincing yourself that this business is now going to take off. The earlier you get in, then probably the better returns you're going to have if those first two things are true. And so there's a lot of judgment around, how you're going to take this to market. Is this business going to really scale and so forth? But and that's through the transition from seed to Series A.
Fantastic. Sia, what's your take?
Right. So I think we're at a stage now where there's probably not an industry or a type of product that a startup doesn't exist that is trying to disrupt it using AI. So you don't have to go into an industry or a domain that you don't understand. I mean, I personally am only investing in products that I care about and in industries that I understand. So one place to start could simply be, if you're in property, I'm sure there's AI in property, right? If you're in travel,
Absolutely.
there's AI there. So domain knowledge is very useful. So let's not get carried away with like it's an AI startup. And then beyond that, I would say starting now. So it's, from a timing perspective, it's all out there, right? So all the cards are on the table. So I would say, especially if you're looking for a quicker acqui-hire type exit, the next year or two is kind of when it's happening, I would imagine. If you're looking for something longer term, so a sustainable business, then I think we'll see a wave now. And then if you kind of compare it to whether it's 3D printing or the web, you'll probably see another kind of a peak in the next few years where you're kind of looking at kind of longer term, more sustainable AI-centered businesses.
Excellent. Alexandra,
Okay,
what do you think? Have we missed the boat? Is it too late?
No, so I would play it even later. So I would play this game around this acqui-hire, kind of almost like a flip at the moment, but only through a fund.
Mm-hmm.
Or a very diversified portfolio if you want to take the time to do that and concentrate in areas where you understand, where you know the management, where you're able to follow other investors that you have confidence in. But there is no harm in waiting. When these things get commercial traction, there is still upside.
Right.
And there is significant upside. And that's just basic common sense investing. When these things get commercial traction, like a dark trace, for example, there's still plenty of money to be made.
And so that's a really good point. So it seems like there's an opportunity to get into these angel deals, especially there's organizations like the AI Seed Fund and Firestartr, or you can go in directly if you want to roll the dice. How do you get into those later stage rounds? If you want to wait and see dark trace getting traction, do you have to be an LP in a venture capital fund, or do you think those companies are going to go public? What's your...
Yeah, some of them will certainly of that particular stable. It is a challenge if you can get into those funds. Might pitch sort of GP Bullhound. So we're setting up an investment fund at the moment that's an LP, and we'll be investing in sort of later stage, and we can effectively trade the secondary stock, so we can get into things quite late, for example. And I think there will be more vehicles to get access to that later stage technology, because the public markets have stopped working for us at the moment. But public market investors and angel investors need that later stage exposure. I think these vehicles will start to come through.
So this would be like a liquid secondary market for private companies.
Yeah.
Interesting.
And I think that will increasingly happen over the next 3 or so years.
Okay. Michael, how do you get the target and the timing right?
Well, at the AI Seed Fund, we believe the timing is now. There's a shortage of data scientists right now. There are more coming through university, but once they're out in the workplace, we won't see the same kind of acqui-hire situation that we are now. It may take 3 to 5 years for that supply to get out into the marketplace and in the workforce, but for the moment it's not, and that's what's creating these really interesting early exit opportunities for companies that might have become either write-downs or failures, but still now have an ability to get purchased at interesting multiples. So
would you call them a flip? Alexandra mentioned the word flip, or is it?
I think they're an additional exit option that may not be here in 5 years.
Right, a moment in time.
And
how long do you think that moment's going to last?
It's hard to say.
The next 12 months?
I think it'll be around for a while.
Okay.
I think at least about 3 years, maybe up in 5, because there's more supply coming into the workforce because more and more people are getting trained with these skills, but also there's more and more demand for it. So I think it'll be a while, but now's the right time to get started. In terms of picking the right targets, from a business perspective, we use a methodology at AI Seed Fund called the 5 Ps of AI investing, and it's kind of borrowed from something a VC called Matt Turk has put together on the subject. But basically, the first P is positioning. We've talked about this difference between horizontals and verticals. And what we like to see is a startup that's taking a vertical approach and solving a very specific problem, because that's where they can have an advantage against the larger tech corporates who tend to be better at broad solutions. The second P is product. We want to make sure that it's a delicious product. And we also want to make sure it's the right product for what customers want. And actually, a lot of AI and machine learning companies don't get that right. For example, around accuracy. If you're building something like a Netflix-style recommendation engine, then you only need like 80% accuracy, and sometimes getting up to like 95, 100 could take the startup years. So if 80 is only required, but the team is trying to get to 100 and wasting a bunch of time and resources, that's a red flag. But other times you might have a situation where, like with driverless cars, where accuracy's got to be 100%. And if the company's not trying to do that and saying 80% is okay, that's a problem too. The next P is petabytes, so that's data. And there are two parts to this. Obviously, in order for an AI machine learning company to work, it needs access to a huge amount of data, and it needs to be able to go through it in order to make its algorithm better. What's a bit more subtle, and something that actually a lot of AI machine learning companies get wrong, is that data needs to be replenished. That needs to be part of a feedback cycle where, yes, a huge amount of data is parsed, and it's used to make the algorithm better, but that then in turn needs to attract more data into the company in one way or another as part of its business model. And that data then needs to make the algorithm better, and that in turn needs to attract more data, and so on and so forth. It needs to be a continual feedback loop for if you want to make a sustainable business that can grow exponentially. And a lot of companies and really smart people, for some reason, don't always get that right. The next P is process. Often in early stage companies, what you measure is what you become. So we want to make sure that they've set up processes to measure for the right metrics. And there are also certain things like around data privacy that you got to watch out for these companies. And finally, the last P is probably the most important, and that's people. I mean, you got to have great people. It's all about the team. That's what you're investing in. You're not investing in hardware assets. You're not investing in a network effect for a specific type of software. You're investing in a team that can build a B2B tool. And that team needs to be really smart. They need to have typically PhDs, but they also need to be entrepreneurial and business savvy. So those are the 5 Ps that we kind of look for to begin with before we'll consider a company. And then if we like it, then we get our tech guys to go in, look under the hood and kick the tires and make sure that the technology actually works.
Fantastic. So it's the 5 Ps. We need delicious products. The timing is now, or later, or later. The timing is now, or later. I mean, it's interesting. I mean, look, I think we've got broad agreement that there's an incredible opportunity. Sounds like in every sector, horizontally and vertically, it's not hype. There's a real opportunity right now, and it sounds like there's broadly this agreement around 2 phases of exit. There's acqui-hire type sales that are taking place already and will continue, but we think there are going to be some much bigger exits as well. I mean, obviously Mobileye, which is Intel's recent acquisition at 15 billion, qualifies as a big exit in anybody's books. And DeepMind, which is obviously one of the most famous examples, by comparison at 600 million is almost a small exit. So it seems very exciting, and just listening to the panel, it seems like the early stage opportunity is almost, in some cases, your option to get into a deal, so that you potentially could invest more later, because maybe the opportunity to get in later is going to be harder. But maybe Bullhound has an answer for that too. Now, listen, I'm going to open it up to the floor. Can we see raised hand questions? Luke's going to come rushing over with the mic. There we go. Question number 1.
Thank you, Paul. Very interesting. I'm very interested in the internet in the second half of the 90s. I worked in a finance background. And,
could you just say who you are so that people...
Michael Pennington, I'm one of the 2 founders of Gumtree.com. I went off and I did a course with the local council called Internet for Business. It was every Friday for 8 hours for 10 weeks. And I learned to program in HTML badly, understand why you need databases, how to buy URLs, how to build a website in a very, very simple way. But as a non-technology person, that gave me a fantastic background into building a business. And I feel now it's wonderful hearing what you've all got to say. It feels a little bit like sort of 1997 to me, with your enthusiasm, and that's wonderful. But to those of us, and I think there's probably many of us who don't really understand AI, what would you suggest, deciding over the panel, is a good way for those with a limited amount of time, but some time, to get a little bit more in depth with AI and sort of understand it?
Who would like to pick that up? Because I saw a large show of hands there in terms of questions, so let's keep the answers super short.
Obviously, I'm biased, but I would say invest in something like AI Seed Fund, because what we do is we give a broad exposure to companies, but also we have something that we call our quarterly updates, and this space moves really fast, and the technology changes very quickly. And so what we do once a quarter for investors who put money into the fund is we showcase where the technology is at that given time, and then we showcase to our investors the companies that are in our pipeline that we're looking to invest in. And if one of our investors has specific sector knowledge, then they can add additional direct investment into those companies, become a mentor or a specific angel to those specific companies. So it's a nice, the AI Seed Fund is a nice way to kind of get into this industry and start seeing what the menu of options might be for you to make direct investments that have already passed a very strong first filter.
Thank you, Michael. Michael, did that answer your question?
I think there's, very interesting, I'm sure maybe there's another answer out there as well. A lot of people don't have the ability to invest in seed funds. There might be an 18-year-old who wants to
just learn more.
Learn more about this.
Alex,
I'd make a recommendation that I have not followed myself, but apparently there are some awesome courses on Udacity and Coursera that I think are well recommended. But also sign up to the CognitionX newsletter, but the combination of those two.
Alex, you're right in the middle of this space and helping people be more productive. Is there any quick shortcut way to get up to speed on the technology?
There are a few really great lists out there. I'm happy to tweet some out afterwards that just give you, hundreds of resources for sort of, learning from, the very basics all the way through to, the most complex concepts within AI and machine learning. That's one of the great things about it, is it's a technology which has continued to evolve its sort of corpus of information since the 90s and before, and it always has in a way been an open technology from publications and research that has been put out there. So it's certainly not there's certainly no shortage of content, and there's obviously a huge amount being created by the current market conditions. So
fantastic. Next question.
Yeah, my name is Jarvis. I teach a course at Oxford University. I am also a fintech data scientist. My question is for Michael. And you mentioned about data, which is absolutely critical. So my question is that when you come to invest in a startup, would you look for them having the ability to have access to large amounts of data, and more specifically, large amounts of label data? Because otherwise, you wouldn't be able to train a deep learning algorithm unless you had the ability to either have access to label data or have the ability to somehow solve that problem.
Oh, absolutely. I mean, without that, you're not going to be able to build that functioning feedback loop that I mentioned. But we invest in companies at all stages, so sometimes they haven't gotten to that stage yet. Obviously, we want to invest in companies who've gotten as far along as possible and have had the data labeled as much as they can, but we can come in an earlier stage and help them get to that point if we need to.
Any other answers on the panel to that question?
You can generate your own data, or actually what we found is a way of accelerating that for a startup that isn't sitting on a mountain of data ourselves, is to work with other companies, help them to solve, to actually process their own data, and that allows us to create the recipe for building models for other people.
Sia, anything to add to that?
I was just going to say, technically, there are also unsupervised learning techniques that don't require labeling as well. So it can be unstructured, unlabeled data as well. I mean, with a lot of the things we're doing, so some of the training algorithms we'll be using at A.I.Music require access to professionally produced music, commercial music. And before we get licensing terms from the labels, we're just going to go to unsigned artists and use their data instead. So if we don't get access to the juicy stuff, we can still train our algorithms on something else.
Fantastic. Next question. Barry.
Thank you very much. My name is Barry Schreier, and to begin with, if I could very briefly, Charlie, just thank you for another fabulous event. Thanks to everyone at CognitionX for a brilliant evening, and of course, thanks to the panel. Very, very interesting and informative. I'm thinking about the issues of the investment cycle and the timing. Could I revisit the question about timing?
Of course.
I'm a huge fan of the movie The Big Short. I hope you've all seen that. It's really entertaining and also insightful. So my question to the three investors on the panel is, what techniques are you deploying to try and measure where we are in the hype cycle and where we are in the bubble, so to speak? And then related to that, just one more quick question. What happens when AI does better than all the PhD AI graduates in creating AI? And what impact will that have on exits?
Nice questions. Who on the panel would like to take that?
I'm going to start on the cycle. I think it's been proven many times it's incredibly hard to call where you are in the cycle. So I think focusing on the the fundamentals of great companies is probably the way to go, but also looking carefully at not just portfolio diversification, but also time diversification. You don't want to kind of rush in because then maybe you bridge a cycle at the top of a boom of some description. But I think another couple of things in terms of timing related to cycles. One is we've not had the kind of boom or the kind of inflation of prices over here in Europe that has ever happened, has happened rather in the US. So I think that means it's still a good time to invest over here. And I think just it's sort of related to this question of timing. I think we've got the kind of rise of should we call it Trumpistan of some description across the other side of the Atlantic.
The first mention.
And we have, should we say, and that creates an opportunity actually, and we also have the challenge, I would like to say, of Brexit. And I think we can choose this time as the moment to be investing in young companies, building on fundamental technology, as one that actually capitalizes on the fact that people are stopping to the brain drain is stopping to some degree across the Atlantic, and that we want to support companies that are using their bases or have their base here in the UK. So I think.
Thank you, Mike. We're going to keep going just because we're going to run out of time to get people's questions. Who else has got a question? Here we go.
Yeah, I have a question here. My name is Lauri Tuomala, and I work in the biotech sector. And as for anyone working in the sector, I am no stranger to ethics influencing regulations and legislation. So my question to all of you is, do you see any potential risks like that in the future of AI? As, well, let's call this revolution speeds up, I think it's plausible that the government will struggle to keep up with the advancement of AI and such. There might be some issues with legislation or regulation. What's your opinion on that?
Well, I'm going to suggest, just so that we can get around as many questions as possible, as we keep going and passing the mic and getting some more questions teed up. One at the back there. So regulation.
There's a question to Alex, actually. I currently use AI to help companies solve operation and business problems. The good thing is it's easy to unbuild. The bad thing is it's very intensive and time consuming. If you were in my position, what do you do in a year or 3 years' time?
Thank you. Next question.
Hi, my name is Ramesh Haridhar. This question is for Richard. So what sort of returns have you seen in acqui-hires? I've done about 30 angel investments over the years. 5 or 6 have been acqui-hires. In most of those cases, investors are lucky to get their money back. Maybe a 2x here and there. But I was curious into what your experience has been with acquihires for early investors. It's quite often, if subsequent investors come in, the seed investors get wiped out. So that's a preference.
Thank you. Any more questions? One at the front, Rod. Right here.
Yeah, my question really follows the last one in as much as we're looking at a really exciting time with AI changing so many businesses, so many big businesses, fundamentally over the course of the next 2 or 3 years. You mentioned the acronym MAFIA for companies, big tech companies that are making acquisitions in AI. I just feel it would be right to say, we're talking about early stage. I'm an angel investor, probably, and therefore speak in a slightly cynical, damaged way, simply because even sometimes when you get it right, you can still get wiped out by the subsequent rounds. Would you not be better to stick your money into those large organizations that are making acquisitions that stand to be transformed? Because firstly, you're safe. Secondly, that the indices are really cranking those companies up. And you might make more money, actually, out of that than you would out of the slightly more precarious early stage seed type investment.
Okay, we're going to take one more question. Is there one more question in the audience? And then we'll let the panel respond.
Hi, this question is Alex, also the investors on the panel. In terms of being open source, how have you found the investors' response? Obviously, there are pros and cons to being open source, and how have you dealt with those? And also, from an investor's perspective, how do you deal with open source companies that come to you that are seeking investment?
Brilliant. Okay, so I don't know if you guys managed to get any of those down. So there's a question around regulation from a biotech perspective, but maybe in general. There was a question to Alex about his plans for the future. There's a question to Richard about the returns in acquihires. There was a question generally to the panel saying maybe you're just better off investing in the mafia, or certainly in the big public companies who are already established, rather than coming into these angel rounds. And the last one related to open source. So Michael, should we start with you and work across the panel? Which, if any of those questions, would you like to address?
I'll address the should you invest in the big guys or seed stage. And yes, obviously seed stage investors will get diluted. But you need to pick the deals where the capital uplift you believe is going to outweigh that. And you're not going to see from investing in a Google, 5 to 15 times return on your investment. It's riskier, yes, but there are higher multiples to be had, and if you pick the right deals, then you won't get too diluted. But even if you do get diluted and your piece of the pie shrinks, if that pie is huge, you're still pretty happy. And also, if it's structured as an SES investment, that takes a lot of the risk out.
I was just thinking of VC, it's like up 15%. I mean, it's not 7x or 10x or 50x.
Do you want to pass Rod the mic?
Looking at a fund, I don't see those types of returns coming from any funds anywhere. Maybe I'm wrong. Maybe I'm investing in the wrong place.
Let's keep going. Michael, thank you for the response, and maybe we can come back to it because it's a big point. Alexandra, do you want to touch on that or any of the other questions?
Yeah, I mean, diversified portfolio, and substantially all my money is in large global tech. In terms of the regulatory angle, I think that all politics, all economics, all legislation is going to be replaced by AI engines who have a far better understanding of the future than we do.
I think you've got a lot of support here. Sia, in any of those questions, regulation, I think Alex got a specific plan for the future, acquihire valuations, going into the public companies and open source.
Sure. Well, regarding things like regulation, for example, I mean, our previous company, we're working in aerospace and in orthopedics. So medical and aerospace, both highly regulated industries. And even though we were able to pretty much automatically, with a button click, design an entire product, whether that's a cranial implant or an aerospace part. It still had to go through the regulatory processes, so you still had to have an engineer or an orthopedic surgeon sign things off. So I think you're going to have that buffering of the human for the time being. More interesting challenges are around things like autonomous vehicles, where, if, you know, as you can imagine, if your car hits someone, whose fault is that? Is it the guy who wrote the navigation system? Is it the car? Is it insurance? Is it the person driving? Is it the person who crossed the road? So those are some really interesting ethics questions.
And from an investment standpoint, and your business, obviously you're successful and exited, and it sounds like it was working in these regulated industries. Do you think you should steer away from regulated industries or towards them? Is there an investment thesis there, or is it
I don't know.
point?
For me, I like to go for the hardest challenge. So for me, I would like to see more kind of AI startups in B2B. I think a lot of the things that are kind of public facing are the ones we hear about. I think going really deep into some sort of industrial, probably like chemical engineering plant, you know, working out how to regulate that is probably where a lot of kind of AI startups aren't. So that's the kind of place I'll probably go to.
Okay, thanks for that. Richard, any other questions posed? You specifically was addressed to you about the acqui-hires, and do we really get good returns there?
I'll try and pick that one up. But first off, I would definitely agree with Alexandra. I think that we have not even begun to scratch the surface in this conversation about the impact of kind of the combination of models of decentralization with artificial intelligence. I think that's a whole kind of mind-blowing conversation for another time. Bring back to earth a little bit. The open source question first I'll address, because I work with folks who built successful open source companies, and the answer there is it is actually pretty hard to build successful open source companies, particularly today. But by the same token, every successful company includes a hell of a lot of open source. That's just the way it works, and all those big companies, be they fresh ones like Facebook or you know, old ones like IBM, are investing enormous amounts of money in open source projects. In terms of returns, you know, I was seeing some meme kicking around today along the lines of kind of, you only have to be sort of spectacularly right once for everybody to think that you're a genius. And you know, we look at angel investors who are lucky with, and I use the word lucky, with one or two investments, and everyone's go, great, you know, I'd like to be a genius as well. And you pile in, but you know, there's a lot of luck involved. And whilst I actually would totally support investing in the mafia, I think that's a great home for your money. It's not as fun or worthy as investing in early stage startups. And on top of that, yeah, you're not going to make most likely 10 to 15 times your money in an early stage fund, but you know, the top flight funds can be going 25%, even 30% IRR, and they can, even in Europe now, that's happening, and that you're looking at an outcome of, you know, 3 to 4x net for those very top funds. And
over
with
what
the
period of time?
That's over a 10-year period, 3 to 4x. Right. But you're with the chance, which you're not going to get in your private equity investments, that it could be double that. And it's fun and worthy as well.
Alex.
Yes.
I'll try and answer both questions.
Go for it.
So I'll just add to Richard's point that yeah, open source is incredibly competitive, and that's why if you see an open source business that is gaining some traction, that's impressive, because actually it's not sort of hiding behind the kind of veneer of a shiny website and some marketing, you know, spin. It's something which you know, developers are incredibly picky, and they'll flip from one thing to another if it's not delivering for them. You know, so if you see startups which are gaining some early traction in open source, then there's a good signal that the team have you know, developed some technology which you know, has a lot of potential, so that sort of leads on to I think the question was about the sort of next 3 years ahead with Seldon, where we're going.
Yeah. Plans for the future.
Plans for the future. So first, I'd say I'm looking a bit further than 3 years, and I suppose the plot twist here is actually that you know, although we are very much laying down the foundation with open source, I suppose my thesis as an entrepreneur is not the same as, you know, the playbook, which is perfectly respectable and a great way of building a valuable business. What I believe is kind of, you take that analogy of like a house, if you lay down the foundation first, and then have enough people starting to use that, and then you start to build the skyscrapers on top of that, rather than building thin skyscrapers and then try to sort of go down and build another one. So my sort of philosophy there is with open source, it's a way of getting your technology out to a much broader community early on. We have thousands of data scientists using our technology from all over the world that we couldn't afford to go out and engage directly.
Dare I ask, which are the most popular countries using your?
Actually, I heard from a friend at Google that Seldon is a thing in India, which I'm very happy about.
You're a thing.
We actually early on the biggest country was actually South Korea, and we did no marketing there. Someone picked up on early a bit of PR. We wrote it on a Korean blog, and before we know it, we've got hundreds of people signing up. Where we're going is actually to create industry models which solve very specific problems, and then we're going to use Seldon as the distribution channel for those models. That's kind of part of my sort of contrarian view on the way that industry is going, is that sort of black box APIs are sort of not what businesses are looking for. They're looking for engines that basically they can plug on top of their own data, and so giving them the infrastructure to process the data and giving them the engines to to do the processing, I think will be more attractive. And then when we've done that, then we'll open it up to a broader ecosystem, so that other companies who are focusing on solving their own specific problems can plug those models into Seldon's ecosystem.
Sounds very exciting. And just to check where we're communicating the alternate views. So there's the other view is that you have these APIs which are a black box, and you really don't need to know much about the model or tinker with the model. You pass it a photo and it tells you what's in it.
Exactly.
And in your model, you're able to actually build the model as the customer. You're able to tinker with the model and tune it to be the thing that you want. Because it kind of comes to a really important topic, which is, when you start using AI in a company, does it become part of your intellectual property? Does it become a source of competitive advantage? Or is that competitive advantage kind of lost to the cloud partner? So it sounds like you're talking about a model where you're keeping that secret sauce inside the organization.
Yeah, so for more kind of trivial standard use cases, which are very common and still valuable, APIs do work well, right? So a standard image classifier for public images, for example, that is a classic kind of API-driven use case. It provides a huge amount of data to basically build all of those edge cases into the model. Where you want to do something which is more specific to your business and then gain a competitive advantage, what we were talking about earlier is this data network effect. Rather than giving that to a third party, you can keep that IP to yourself, and that's why when a lot of large organizations are making decisions about their AI strategy, particularly banks and big financial institutions which are sitting on mountains of data, they know that they want to keep that IP for themselves, and the only way to do that is to build the models in-house.
Got it. We're going to do one more call for the questions from the audience. And if we're clear, are there any final comments anybody on the panel wants to make? Michael, Alexandra, Sia, Richard?
It's fun and wordy.
This is a 20-year play. This is structural, it's not a cycle. It's a revolution, it's genuinely transformative. It will transform the GDP of this country. So you have time to learn about what you need to learn. I think within 3 years' time, we won't even be having these very deep technical conversations. We're going to be talking about outcomes, applications, revenues, profits.
Yeah, and I'd add to that there's a difference between an industry that's booming and one that's in a bubble. You mentioned the mortgage crisis, and similarly, we had the internet bubble in the late 90s, early 2000s, and those happened because people ascribed fake values to things, but then you have, and it created a bubble because they weren't actually worth what people said they were worth. However, then you have things like mobile or cloud computing, which have just grown and continue to grow and are having high valuations because they add a lot of value. And there's a big difference between that and something that's in a bubble.
Thank you, Michael. Sia or Richard?
Yeah, I think just to add to that there is this kind of 2 or 3 acqui-hire flip, we could argue, that does exist. I'm personally more interested in longer term investments, so the big kind of fundamental changes is what I'm interested in.
I think it's been said.
Well, listen, thank you to the panel.